Good morning, dear students. Today, we are going to have another webinar on finance controls and audit. Today, our lecturer is Mr. Tharanga Madhuraperuma. He is a member of AAT and also a member of CA Sri Lanka. Not only that, he is a lecturer on the same subject for our AAT students. I would like to cordially call upon Mr. Tharanga to continue the session. Over to you, Tharanga.
Yeah, thank you very much, Leilani, and good morning, my dear students. Hope you guys are safe at your homes at the moment. And we'll continue our session with the second webinar series, and I'll welcome all of you to the second session, as well as our second chapter of the subject, the financial controls and auditing. So before moving to the today's chapter, I'll quickly explain where we are at the moment. So like I explained last week, the subject is financial controls and auditing. By the meaning of the name of the subject, you can see that there are two parts: financial controls and auditing. But we can't just come into these two technical areas in financial controls and auditing before having a solid understanding on the business organizations, their natures, their environment, their objectives, what types of business organization, because this concept of auditing is applicable for certain types of business organization, not all business organization, and the scope of this concept auditing can vary with the nature of the business and with their objective, the external factors affecting to them, and of course with the risk affecting to the business organization. So I think so our second chapter is risk management framework. I think this is the ideal time to talk about this chapter, the risk management, as we are currently facing a significant risk from the external environment. So I'll go to the slide presentation and we'll discuss the areas which are coming under your examination scope, examination context, and we'll discuss with the examination focus from where the questions can come in your examination. So let me share the slides presentation with you. Right. So I believe everyone can see the slides well. So, so this is the detailed content of our subject, financial controls and auditing, and business environment and governance framework. Our first chapter we discussed last week. For those who were not participated for the session, I think the session is available in the social media and in YouTube. Then the second chapter, risk management framework, is what we're going to discuss today. Right. These are the detailed content coming under the risk management framework, the external and internal risk of an organization, then the risk management framework, then the technique used to mitigate risk. Actually, in previous syllabus, we are having only these three areas, but in the coming new syllabus, in addition to these three areas, we have added the technological aspect, right? Because these days, how business organizations are doing their businesses, and what is the impact, what are the risks coming from these technological areas, as well as how you can manage it by using technology. And there are some pros and cons, benefits, and as well as disadvantages. So we will discuss these two areas in addition to your previous syllabus, which is coming under your new syllabus. Right. When it comes to the risk management, or when it comes to the risk, what is the first thing coming to your head when you hear the word risk? Right. It's uncertainty. It's uncertainty. Something whether you will, whether it will happen or not. Right. So when it comes to a business organization, when it comes to the risk, it's the uncertainty, and it's always linked with the future. Uncertainty is always coming with the future, like we are facing right now. So what will happen tomorrow, whether it's positive or negative. So likewise, so when it comes to the business organization, rather than focusing on positive uncertainties, the business organizations are more tend to address their negative uncertainties, the unfavorable impacts coming from uncertainties in the environment, how the business organization has to manage this, because the management of this risk is really necessary, and which is directly linked with the survival of the business organization. Gradually I'll explain with very detailed examples when I'm going forward, but for the moment this risk management is purely linked with the survival of a business organization, because if something happens negatively to a business organization, and if you are in a position not to manage that, you will end up your business journey. The business organization has to maybe wind up in their business operation. Like the example, suddenly you guys may have remembered some years ago, suddenly there is a ban came to the polythene industry, polythene products. So if you are in a, that's a risk came from a legal environment. So if you are not in a position to manage that risk, so obviously you would have shut down your business organization and find something else. So that's the severity of this topic, risk management. And as a business organization, definitely this, you have to maintain a solid business risk management framework. And when it comes to auditing as well, so there's a direct link, and gradually you will learn the link of this business risk coming from a environment of a business organization and how it linked with the audit risk. So today I'm not going to explain and link these two, and you will get to know that in future. Before moving to this, the broad classifications of risk, as I told earlier, you can see it as like a negative risk as well as it can be a positive. So for a business organization, it's important to find out clearly what are the negative risks. So risk that actual results or events will definitely worse than expected. Now let's say the employees of the business organization suddenly decided to do a labor strike. That's some future event, so it can happen or cannot be happen, but that's a risk. And if that labor strike happens, of course you know that that will ended up with some negative impact. So that's what we considered as a negative risk. Now but there are some incidents, you know, but you don't know specifically the result is going to be a negative result, but there is a possibility of ended up with a positive results as well. For such incidents we call speculative risk that actual events or results will be either better or worse. Let's say you are launching a new product to the market, so there is a possibility of succeeding the product, or there is a possibility of failing the product as well. The two sides are there. So that's why it's important as a business organization to find out the incidents, the uncertain incidents to be happen in the future are negative or speculative. Based on that, your strategies toward that has to be changed. With that, I'll move to the broader classification of risk. And in your exam context, under the scope of your examination, basically we need to classify the risk as two broad classification, that is the internal risk and external risk. I think we discussed this internal factors affecting to a business organization last week, and the external factors affecting to a business organization. So it's the continuation, right? So the internal risk means there can be some incidents, uncertain incidents can happen in the business organization, within the business organization, which can manage the company, and the uncertainty, there will be like the possibility of ended up with the incident with a negative impact is high. So there are four types of internal risk we can identify, that is the operational risk, fraud risk, compliance risk, and the reputational risk. So these four types of risk happen within the business organization. There is no impact coming from the external environment. Purely the factors, or purely the factors within the business organization may ended up with the uncertain incident and ended up with the business risk, internal risk, which will generate a very negative impact to the business organization. The first one is the operational risk. So you guys know that operation means the business, the day-to-day operations, right? Let's say if it's a manufacturing organization, they are inputting their raw material, the machines are operating and the product is manufacturing, and finally they are selling the product. That is the process of a manufacturing business organization. Let's say suddenly a machine breaks down. So that's a risk. That's an uncertain incident which can happen in any day, any future day. So if what happened if a machine breaks down, that entire process of business operations we have to stop at one point, and it will ended up with like we are unable to manufacture the product on time, we are unable to cater the customer on time, we are unable to deliver the product. Then there's a possibility of losing the customer. At the same time, customer will spread the news around the market that this particular company is not delivering the goods at in time. So the repercussions are really, really high. So that's why, so those type of incidents we can consider as operational risk, and we have to manage and we have to make sure that we are not ended up with the operational risk. That is, we are continuously doing our smooth operations by managing those risks. So in future, in a different slides, we will be addressing what are those risk management techniques, right? So for the moment, we will discuss all the risk elements, and we'll move to the risk management techniques later. Then the second one is fraud risk. You guys know that what is a fraud, right? So which mainly has two parts, that is misappropriation of company assets, as well as incorrect financial reporting. So in a business organization, this fraud can happen at any time, right? So therefore, the business has to take necessary steps to avoid frauds. If the fraud happens, the repercussions coming to the business organizations is very negative, and that is why it is considered as an internal risk. The third one is compliance risk. Most of the business organization, actually not the most, all the business organization in a country is governed by different rules. If we take tourism or the hotel operating in a tourism industry, so there may be separate government organization to monitor that, and there may be separate legal requirements. So if we take a bank as an example, there is a government monitoring authority like the central bank. There are so much of relationship between the central bank and the commercial banks in Sri Lanka. There are various types of reporting statutory requirements. Likewise, if you are in the telecommunication industry, you are providing telecommunication service, it's governed by the telecommunication authorities in the country. So likewise, and most importantly, the non-compliances with these authorities, these laws and regulation will create a very significant negative impact repercussions to the business organization. So therefore, the business has to manage that. The company is managing their compliances, legal compliances in an accurate level. So finally, the reputational risk. That means the reputation means how the external, mainly your customers, the external environment, the market or the industry, mainly the customers are looking at you. Let's say we'll take operational risk, a labor strike happens. So it will end up with a reputational risk as well. Because of the labor strike, you couldn't manufacture the product on time, you couldn't deliver the product to the customer, and you are losing the customer. So it will end up with a reputational risk as well. At the same time, let's say there is a fraudulent activity in the business organization, you are having a fraud risk. As a result, it will end up with a reputational risk. So how the external environment, mainly the customer base, the market, external market is looking at you, the negativities they are having on your company can create significant impacts to your business organization. Finally, you are losing the customer means like you may have to shut down the business as well. So these are the risks or the uncertain incidents which can happen within a business organization. As a result, there is a negative impact. That's why we call them as internal risk. And most of the time, very importantly, most of the time, you can manage these things. That means before this happens, you can manage these things as a precaution actions. Before before these incidents happens, you can manage and make sure these things are not happening in a business organization, because these factors are internal, within your control. So the next and the important part is the external risk, which is beyond your control, right? But somehow you need to face, like the first example I took, that the polythene industry, when the ban came for the polythene product, and also the prevailing situation in the country. Those are the factors coming from the external environment. And importantly, it's beyond your control, and you need to manage somehow to survive in the business organization. Last week, under the business environment, we talked about the factors affecting to a business organization. It's the pestle, initially pest, then it became pestle, then now things are changing, evolving, and it's going to become pestile in one future day. Pest means the political, economical, social, and technological. The two new additions are the environmental and legal. So now when it comes to the external risk also, the risk factors coming from these areas. Basically, we are discussing about the risk coming from a political environment, technological environment, then the social environment and the technological environment. Likewise, before moving there, these external risks, we can further divide it into two parts. That is the risk in the general business environment and the risk in the specific industry. So I'll explain with an example, and I'll request you to write down all these examples when I'm talking, because as I explained last week also, we are looking, when we were looking at the exam focus, your past papers, all the questions are come with a very minor case study, a business application. So therefore, examples are very important, and it's really easy for you to understand the concept as well. So write down all the example when I'm referring, right? So it will be really helpful for you to continue your studies, and especially when you are writing the exam. So external risk, broadly we can divide into two parts: risk in the general environment and the specific industry environment. So the general environment means, the best example is the current situation, this COVID-19 pandemic situation. So that's a risk in the general business environment. All the business organizations are affected. All the industries are affected, whether it's a banking industry, whether it's a manufacturing industry, whether it's a service providing, whether it's a business, educational institute, right? Or whether it's like a small and medium enterprise, small business organizations like these salons and all. So whatever the industry, generally the factors have affected all the business organization. So how you have to manage those things? So those type of risk we call risk in the general business environment. The second broad classification is the risk in the industry environment. That is, a particular incident happens particularly to a specific industry. As an example, let's say a new technology coming to the mobile industry. So there will be a negative impact coming from the mobile industry, and only the companies operating within the mobile industry is getting affected. There is no impact to banks, there is no impact to educational institutions, there is no impact to other manufacturing organizations, only to the telecommunication business organization. And we have seen so much of examples. You guys may have heard the case study of the Celtel and Dialog, very local examples, right? When the Celtel is the first telecommunication service provider, but they were not managing their external factors well. So as a result, the Dialog came into the market, and suddenly that the survival of Celtel was cancelled. So now it's the Dialog. Now they are facing the future incidents properly, and they are facing their risk properly, and that's why, that's the secret behind their survival. And also when it comes to the global situations, like this Nokia mobile phones, the new technologies are coming, right? But those are very specific to that particular business organization, that industry. And if you are not surviving, or if you are not managing that risk particularly, it will end up with a very, very negative and significant results, like shutting down the business organizations. Likewise. So with that, we'll move to the that sub-classification of this uh, external risk, which are mainly coming from the general business environment. It will again pestle, but we have clubbed into four actually. The political and legal has been taken into a one bracket, then the economy is in another bracket, and the social factors are in another bracket, and the technology is also in one bracket. And this environment also we have bracketed in the political and legal box, as you can see. The third point, the imposing new environmental laws. So this diagram is very important because when we analyze your past papers during last 10 exam papers, the majority of the question has come from this grid. That is, they were continuously addressing or testing the areas coming from the risk from these external environment classified into these four boxes, right? So we'll take one by one with I'll explain with very detailed examples. So make sure you are writing down all the examples, right, which is very important for your exam. So we'll take the first one, political and legal risk. Last week we discussed the factors affecting to business organization coming from a political background. When the government is introduce a new law, right? Then when the government is changing in a country like Sri Lanka, sometimes the government, the way the governments are working is little bit unstable in some situations. Right. Then some frequently changing laws and regulations, especially when it comes to the income taxation, like frequent changes are happening when the governments are changed, the tax system is also continuously changing. So these are the factors coming from the external environment, external political environment. So under this chapter, what we need to understand not only the factor and the negative impact coming from that factor, and we need to address it to survive in the business organization. As I told earlier, these factors are totally beyond our control, right? If we take a change in government regulations, the best example, some years ago, suddenly the asbestos industry, there was a ban came to that. Let's say you are in the asbestos industry, but very recently it was removed, that ban was removed. Uh, let's say you were in the asbestos industry, or we'll take the polythene example. A ban came to the polythene industry and the polythene products. So let's say you are in the polythene manufacturing industry. So what will happen to you if you are not adapting or if you are not managing the risk well? So you need to shut down your business organization. So therefore, but when the ban came, that the regulators were suggesting some a new polythene product with a high thickness and some technical areas. So if you are in the industry, then you have to adapt to that. You need to consider that, and you need to make sure you are surviving in the business organization. And the second point is instability in the country. Sometimes you may feel that the governments are not stable. In such situations, so what will happen to the business organization? The government instability is something you can't control as a business organization. Somehow you need to run your business organization within a such situation. So therefore, how you can manage that is, like, most of the business organizations are very reluctant to take business decision in a situation like that. So it's very negatively affecting your business organization. So I think in a country like Sri Lanka and most of the South Asian countries, so the business organizations are a bit of like familiar with these instabilities because the frequent government changes and the totally different policies, national policy. There is no national policies actually. The different policies coming with the political party. So the business organizations are ready. They are moving with whatever the policy coming in. They have the capability of adapting to it. So that's how they have developed their skills and developed themselves to survive in the industry. So that's why if you can't do that, obviously you can't survive in the business organization or the industry. Then third one is imposing new environmental laws. Very important. As I told last week, when people are trying to protect something when they are going to lose it. So the environment is also something like that. And we saw that over the last couple of years, the things are happening in the environment. The relationship with the human and the environment is not so good. As a result, some negative impacts are coming from the environment, the way people are reacting. So in order to mitigate this, the government is also tend to introduce new laws that you can't do this, you can't dump your garbage into rivers like that. Like there are so much of regulations are coming. So you have to comply with those. Otherwise, there will be so much of negative repercussions. Then the fourth and the very important point is the new taxes, right? As I told, with the frequent changes in the government, they are bringing their own tax system. They are bringing their own uh, revenue sources, mainly from the taxes. So most of the business organizations are affecting with these decisions. The best example, I'll tell you, in 2015, when the government was changed from the president Mahinda Rajapaksa to Maithripala Sirisena. So there was a new tax law, then the new tax act, and with that parallelly, they brought a new tax called debt recovery levy, uh, which is imposed to all the commercial banks in Sri Lanka. So they actually temporarily introduced that levy, debt recovery levy, DRL, temporarily until they pay all the debts taken by the previous government. So that tax was imposed to the banking industry, all the commercial banks in Sri Lanka. So if a businessman engage in the banking industry, right? So if the business organization is a bank, that factor, that external factor coming from the political environment is significantly affecting his business organization, their business organization. So therefore, the bank has to manage it somehow. Likewise, and there's another example. Recently in last year, they introduced a new accounting standard, SLFRS 9, uh, which has a significant impact to the banking industry. There's a significant change of the way the impairment was computed. As a result, there's a significant impact came from this political and legal environment to these industries. So as a business organization in the industry, you have to manage these things. Now we'll move to the second box, that is the economic risk, which is mainly the factors affecting in the economic environment is the inflation rates, interest rates, and the exchange rate. I think this exchange rate is something most of the business organization, they are engaged in this daily import and export businesses are affecting daily, and they have to manage it. I'll tell a few examples. Let's say you are in the business of importing motor vehicles, or let's say importing some consumable items. So in a situation when the exchange rates are increasing, so obviously the cost of your goods is going up, and you will end up with a negative profit margin. Or maybe at least like you may increase your product price as well, but it will end up with losing your market as well. So as a result, you need to manage these variable factors coming from the economic environment. So we will discuss in what are these mitigating techniques in the future slide. But for the moment, keep in your mind. So some negative impacts are coming with these unexpected incidents. So unexpected movements in these variables such as inflation rate, interest rates, and the exchange rates. And also economic recessions also is impacting business organizations. And we have witnessed in 2008 and 9 the great recession in USA, right? In such situation, some big business organization, some big banks like Lehman Brothers, so those things were like the survival was very doubtful, and they had to shut down their business organization because it's very difficult in such situations to survive in a business organization. And we don't know what is the economic decisions we are going to face after this COVID-19 situation. So we need to strategize from this point onward. We need to forecast, predict, and what will happen if something happen like this, what it's going to be. With the sensitive analysis, you need to manage these economic factors coming to survive in the business organization. Then the third one is social and cultural risk. Like I explained last week, the social environment and the cultural environment mainly includes the customer behaviors. Customer behaviors and based on their beliefs and value. Right? If we take a customer, he has some separate set of values and the way of living. His consumption, his behaviors are totally different. So if you are a business organization catering to such a customer, so you have to adapt to his behaviors. And at the same time, the most important part is that behavior can be changed in the very next moment with the change of his values or the way he is living. So as a business organization, we should be like a clear understanding on your business, the customers and their values. Otherwise, the survival is highly doubtful. I think last week I explained this global case study, the McDonald's, when they are starting their plants in the India. The beef burger is one of their favorite products and the most profitable product. But when they start the business in India, the beef burger was a failure because most of the Hindu people don't eat beef burgers. So it was a failure, but somehow they manage the risk and they adapt to the situations, and now they are very profitable in India. Likewise, you have to identify those factors coming from this environment and have your strategies to face the uncertainties. Otherwise, your survival is highly doubtful. Then finally, and the most important one, the technological risk, the negative impacts coming from the technological environment. Mainly the new technology. As I told you, the technology is expiring day by day. It's expired. So as I told last week, as an employee of a bank, I have witnessed that some years ago, the ATM card is a high-tech product in the banking industry. But today, ATM card is a very traditional product in the banking organization. Now it's the internet banking, and the people are not willing to come even to ATM card, ATM machine and use their ATM cards. Now people are tend to use their internet banking from their webs, but that's also getting expired at the moment. Now people want the bank at their on their palm to their mobile. Now it's the mobile banking. So the change of technology has creating big influences to the business organization, not only the bank, like technically all the business organization, like even the educational institute. Like the best example is now this with the situation, how these educational institutions change their mode of lecturing to this digital mode, right? So that's how they are facing their external factors coming from external uncertainties coming from these areas. If the organization is not ready with the technological aspects, they can't uh, conduct these webinar series and they can't survive in the market. They lose their student base, right? So likewise, in order to make sure the survival, you need to be in touch with the the latest technical updates, and also the products become obsolete due to latest technology, as I explained. So these four factors coming from these four environment. Actually, there is not only four environments. There are six environments here. Political, legal, and environment is bracketed in a one box. That is the first box. There are six environments. There are six factors coming in, and which can come in form of a negative way, which will end up with very negative repercussion to your business organization unless you are managing them. So with that, we'll move to the management strategies, how you can manage these external risk. So actually, this risk management is the only solution we are having to a business organization to manage these risks. Because as I told you, most of these factors beyond your control. You can't do anything about that. You can't stop changing a government. You can't stop coming a new act. Okay, you can't stop coming a new virus like this. Right? What you have to do is manage it. So this risk management framework will help a business organization how to manage that. Of course, the first step is the risk assessment. This is the three-step model: risk assessment, then the risk response, finally the monitor. Very simple framework with three steps, but very important. First step is risk assessment. It's obvious, right? When an external factor is coming from an external environment, first of all, you need to assess that. First of all, you need to assess that what are the repercussions coming with that change, or whether there may be incident, there will not be any impact to your business organization. Let's say a government is imposing a new tax on the telecommunication industry. Let's say you are in a business of manufacturing biscuit, and you no need to worry. Like there's nothing, no impacts coming to you from that external factor. So which is coming under the stage of risk assessment. So you have to identify risk to the organization, which can come from both external as well as some internal as well. Let's say a labor strike, and there are some uncomfortable working conditions and some uncomfortable relationships are continuing over the last couple of months in the business organization, and you feel like, okay, there will be a unionized actions from the employees. So you are assessing the risk. If something happen, what will happen to our production process? If we fail to continue our production process, do we have sufficient finished goods in our stores to cater the customers? Likewise, you need to assess the possibility of risk. If that happens, what's going to be the negative impact to the business organization? So you need to analyze it, and you need to use this sensitivity analysis. If this happens in this way, what's going to be the impact? If this happens in this way, what's going to be the impact? Let's say you are in the business of importing motor vehicle. Let's say if the exchange rate with the situation, there's a high risk of increasing our exchange rates. Now it's almost 200. So there are some predictions. It will be like 250, 230 with the negative economic impacts coming in. So if you are in the import industry, so you can do the sensitivity analysis. If the exchange rate is 200, what's going to be the impact to my business? If the exchange rate is 205, what's going to be the impact? If it's 210, what's going to be the impact? Likewise, with the sensitivity analysis, you need to analyze the risk. First, you identify the risk, and then you analyze the risk. What are the impacts? Let's say there are 2-3 risks are coming together. So you need to prioritize, okay, what risk to address first, right? Let's say there is a tax law is with the new government. There is a two new acts are coming. These are hypothetical situations. Let's say two acts are coming, a new income tax act as well as a new environmental act. So what to prioritize first? You need to find out, okay, the repercussions coming from these two changes separately, and what risk to prioritize to address, right? Then the final, the risk evaluation. So in this 3-step model, risk assessment, risk responses, and the monitoring, the first step is risk assessment. Under risk assessment, you can see that there are 3 points. That is, first of all, you need to identify the risk, then you need to analyze it, then you need to evaluate and decide which risks are more significant than others. Okay, so with the examples I told, try to clearly differentiate these 3 sub-steps of this risk assessment process. First of all, you need to identify the risk, then you need to analyze with the sensitivity analysis how it's going to impact your business organization. Finally, you have to evaluate what risk to prioritize. That's the 3rd step of your first step of the risk management framework. I hope you guys are clear what I'm saying. So once again, so the risk management framework includes 3 big steps: risk assessment, risk response, and the monitoring. Under the risk assessment process, there are 3 sub-steps. You have to identify the risk, analyze the risk, and evaluate the risk, right? Okay, so then we'll come to the 2nd step. That's the risk response. Okay, now you have identified the risk. The risk is exchange rate is going to up, and you have analyzed the risk. If the exchange rate went to 200 to 210, this is the impact going to be, right? And you have evaluated the risk, right? So in order to address this issue, these are the areas we need to address now. So you have identify, analyze, and evaluate. Then the 2nd step of your management framework is response. That identified risk bases should be answered. right? Okay, what are the techniques? What are the techniques you can take in order to address the risk identified in the first process? So when we are discussing these detailed responses, risk responses strategies, I will explain with examples. Okay. Then finally, monitoring. So this process has to be a evolving process and continuous process. So this is not a one-time task, because you guys know these factors can change anytime. It's not a one-time incident. Now the COVID-19 may be a one-time incident, but the impacts can come continuously, right? So until we find a solution, there will be negative impact continuously. So you have to keep monitoring, keep reviewing whether you have taken the right responses. Then let's say you have assessed the risk accurately, but the response you have taken is incorrect. You have taken a wrong risk mitigating strategy, right? So that should be found out in your monitoring process. If it's wrong, then suddenly you need to change it, coming back to the beginning and again assess it, response to it, and again monitor. Likewise, this is a continuous process, this framework. Okay, so with that, we'll move to the detailed risk mitigating techniques, which is also very important, practical aspect as well as your exam aspects, because in your past papers, this is an area they have touched and tested very frequently. Basically, there are 4 risk mitigating techniques. We call them risk avoidance, risk acceptance, risk transfer, and finally the risk reduction. This risk reduction has another 4 sub techniques, which we will discuss in detail. The first one is risk avoidance. So by the meaning of the word, you can understand what you mean by avoid. You're avoiding something, right? The risk is coming, okay? You just leave. You're avoiding it. I can't bear the risk, and sometimes it's not much worth to bear the risk, right? Let's say the best example, you are in the business of importing motor vehicles. Let's say we'll say like some Indian middle class motor vehicle, we'll say Alto, right? So that was the motor vehicle at that time with the very minimum prices. Let's say it's 15 lakh, 1.5 million per motor vehicle. Suddenly a new government policy came, and they introduced a new tax, a significant tax to these Indian motor vehicles, and suddenly the price became 3 million, 1.5 to 3 million. Right, so you guys know that most of the time this 1.5 million Indian Alto motor car is the first car of most of the people. Like, it's the transition from a motorbike to a motor vehicle. That's the first step, first motor car in practically. So suddenly the 1.5 million motor vehicle became 3 million. There's a significant drop in the demand. Like, the people who were using a motorbike now can't afford a 3 million to buy an Alto motor vehicle, motor car. So suddenly there's a significant drop in the market, and sometimes you may feel that it's no point of engaging this business anymore. You better move, you better avoid it, you better leave the business organization and find something more profitable with the prevailing acts. So that's what you mean by the risk avoidance, closing down existing loss-making business units. It's not worth to bear the loss, simply like that. And you don't have any other way to manage this, or to reduce, or the transfer, or accept this. So you just leave it. Now this will be different. Now let's say you are in the business of importing, let's say a luxury car. You are in the business of importing a luxury car, let's say 300 million, or like let's say let's say 30 million. Vehicle is a Benz or the BMW motor car is 30 million, and suddenly a tax imposed, or let's say exchange rate high, that 30 million became 33 million now. The price has increased by 3 million, but still for a customer who is purchasing a luxury car, there's no much difference from 30 million to 33 million. So because of that exchange rate impact, or new law, or the new tax imposed, you no need to leave the business organization, because there is no big impact coming from the market. right? So you can stay in the business and you can find some other techniques to reduce the risk. Hope you understand, right? So you write down all these examples as well, right? Then the second risk mitigating technique is a risk acceptance, right? So you accept the risk as it is. Simply, you don't do nothing. Let's say you are in the business of importing motor vehicle to the country, right? So let's say you are importing some Japanese motor vehicle, mid-level motor cars like these. Let's say these Toyota Axios, some middle income people are using motor vehicles. Now the exchange rates are continuously changing. It became 190 to 195 to 200, 202, then again coming down to 198, right? So you feel changes, fluctuations in the industry, the prices every day, but you don't do anything because you can accept that risk. You are within it. You are running your business organization within a risk tolerance level. Understand? Sometimes, let's say from 192, when the exchange rate increased to 220, then it will be a significant increase and there will be a significant change in your strategies. But let's say it's changing within your tolerance level, 190 to 210 exchange rate. How it fluctuates doesn't have a big impact to your business organization. So you are just running the business without considering much on the exchange rate impacts. And you feel that okay, governments are anyway changing, they are introducing new taxes, new laws, right? So you are also used to that. You don't do much because when you analyze your past history, so you have survived over the last couple of years with all these changes, and it's with your tolerance level. You are just continue. You simply do nothing on the risk. That's what you simply mean by risk acceptance. But there are three things you need to keep in your mind if you are accepting the risk, right? As I told you, when the exchange rate become 100, increasing from 109 to 230, 50, right? That shouldn't be a situation where you should accept the risk, right? So that's a significant change in the factor. But when it's increasing to 109 to 200, maybe 190 to 205, 10, that's also fine, right? So likewise, there are three conditions coming under risk acceptance. You have to be very particular, very focused. And if the risk is coming under these three conditions only, you can accept it and doing nothing, right? So what are these three conditions are? You can see in the below box under the risk acceptance circle. Accepting risk when the potential impact is low, right? As I told you, exchange rate is 190 to 195. There's no impact. It's very low, right? And the likelihood of an adverse risk is minimum. Now, let's say we'll take the government introduce this new tax. Tax is something very frequently changing, and there are some laws and regulations very hardly changing. Right now, let's say you are dealing with some foreign exchange. Your business organization is dealing with some foreign exchange activities, right? So act like we haven't heard very recently they changed the act, but it's not something very frequently happen, right? It's not something very frequently the government are trying to change their foreign exchange policies, foreign exchange acts, and all those stuff. So if your business is running and some factors are coming from those areas, and the changes or the change of the factors coming from those areas are very minimum, the likelihood of an activity to happen is very minimum also, you can just ignore that. That's a one-time activity. Once it's happened, okay, there may be a significant change from that activity, but it's a one-time task. You adapt yourself, you just leave it, okay? And the third one is the risk is within the risk tolerance level. In business organization, there's a saying like high risk, high return. I think you may have heard this. So business organizations are coming to the market, to the industry to do a business with the risk. They know that they are facing a risk. There is always a risk of failing what you are doing, right? So there is a risk at any given time. So therefore, people, the businessmen, business organization know that they are running within a risk level, right? So they have come to the business organization with the predetermined risk tolerance level. Okay, from this point to this point, I am okay. Okay, if my profit is somewhere around 100,000 to 200,000, I am okay. Let's say my profit is go beyond 100,000, then I should take a decision. Likewise, they are always running with the risk tolerance level. Within that level, whatever the changes happen, the business organizations are not willing to take big actions unless it's exceeding their risk tolerance level, right? So now hope you guys are very clear on these first two strategies. First one is avoiding. You are just you can't face the risk, you just leave, right? The second one, you can face risk acceptance. You can face the risk. You are not doing anything. You can face this risk, whatever the coming changes, you adapt to that. I am fine. I can go with this changes. Then the third one is the risk transfer, right? Sometimes in business, when you are running business organizations, some negative incidents can happen to you. They transfer to some other party. The best example is the insurance. So that's what's happening in the insurance industry, right? So you are running a business organization, right? There is always a risk of having a fire, having like a falling down the building to your like to the ground. Right? The risk is always there, right? So you can't say that okay, I have accept that risk, right? So the impacts are very negative repercussions can be there. Therefore, you should and the business environment in the environment also the facility is given for you to transfer the risk. Okay, just insure it, right? So it will fall down. You can maybe avoid that, but at the same time, the business losses you are incurring because of that whatever the fire or the natural disaster, it will be uh, compensated by that particular insurance organization. You just transfer the risk to another party. Very simple and a very common mode of managing risk, right? Then the fourth one is risk reduction. That means you are accepting and you are facing the risk to reduce it. Because of that particular change in the external factor, the impact's going to be significant to your business organization. Therefore, somehow you do some actions to reduce that. Understand, right? So there are four strategies: diversification, risk sharing, business contingency planning, BCP, right? BCP, business contingency planning. Then finally the internal. So I'll explain one by one. These four strategies can be very frequently used by business organization to reduce the risk, right? So the first one is diversification. There may be a very like some business organization after coming to a certain stage, they are anyway trying to move to this stage of this strategy, actually diversification. You may have heard there is a famous saying by Warren Buffett: don't put all eggs into one basket. He simply means don't invest in one single place. That's what he meant by don't put all your eggs in one single basket. If something happens to the basket, the entire lot of eggs gone. So therefore, divide the eggs into two baskets. If something happened to one basket, but you still have a basket in your hand, right? So that's what you meant by the diversification. Let's say you are in the hotel industry, right? You are in the hotel industry. Uh, if an incident happened like this, and we know that from the Easter attack happened in last April up to this point, the hotels, the tourism industry is facing a very difficult time. Let's say you are running a hotel, so you must be ended up with very negative repercussion at the moment. So what if you could have invest your money in a hotel as well as another unaffected business organization? Let's say maybe a transport industry organization, right? So they are likewise, without investing in a one single organization, you are investing in two. And if you can increase this like 2, 3, 4 industries, that would be better. So you are just mitigating the reducing your risk by diversifying, by investing in different business organizations. If something happened to one business organization, right, but still you are having a another business organization to survive. Right, so that's a very good strategy, and you may have seen in the big business organizations in Sri Lanka when they are coming to the latter part, like all these conglomerates, big holding companies like John Keel's, Haley's, Hamas, right? So if there is an impact to one single company coming under that group, there is no impact there because there are 100 other companies to survive. If something happened to another company, okay, that's fine. There's another set of companies in the group to maintain, sometimes to bear that loss. If we take the John Keel's in the group, right? So that's a very diversified business organization having like almost all the areas in all the industries, even a bank, they are having the Nation Trust Bank. So that's how they have reduced their risk. If something happened to their cinnamon hotel chain with these Easter attacks and all these pandemic situations, but still they are having 100 other companies to run the group. So that's a very good, very practical strategy, but you have to come to a certain level of your business life cycle. At the initial stage, you can't do this. Then the second one is risk sharing. This is like you may have seen some business organizations are starting as joint ventures. Let's say there's a new business opportunity, right? So you have some amount of money in your hand, but you are reluctant to invest the 100% money into the business because you are facing some, you are feeling some risk will come, and it will end up with a significant loss. So sometimes what you can do is you invite one of your friend as well. Okay, we'll put 50-50 and we'll invest in this particular new business organization. If successful, okay, we can invest more and we'll continue. But if something went wrong, if the things get into the wrong track, then the loss is shared equally between three parties. So that's what simply meant by risk sharing. Sometimes business organizations are introducing new products with the risk of failing the product in the market. Sometimes 2-3 business organizations get together and joining together and combine their issue in the product. If something happened, if the product went wrong, so the loss will be shared among these people and the risk will be reduced. And the third one is the business contingency plan. So in most of the business organizations, they are having their BCP. BCP means business contingency plan. That means if something happens, if a building falls down, or if maybe a fire happens in the main factory building, what next? What we are supposed to do? How we can continue our business? So we should have a plan B. We should have a backup plan to continue the normal business organization. The best example is in commercial banks in Sri Lanka. Actually, this is a mandatory requirement to have a business contingency plan. You guys know that in the business or the banking industry dealing with public money, right? Let's say something happens, some natural disaster, some cyber attack, or something happens to the banking industry, and we can't say as the bank to the public, a fire happens, as a result all the records were burned, so we can't give your money back. We can't say like that as a bank, right? So therefore there's a mandatory requirement. You should have a business contingency plan. You should have a DR site. We call it a disaster recovery site. If something happened to your head office building, the same activities can be continued in another building located in bit of a far away, maybe 30-40 kilometers away. Your head office building, there's another head office, backup head office. All the transaction systems, servers are located there as well. If something happened to the head office building with a natural disaster, but still you should be able to run your operation in another building. So these are business contingency plan. If something happened, how you can come back to your normal operations. Very important. This is in some industries, like I said, in bank, this is mandatory, but in some business organization, it's not mandatory, but you can reduce the risk and you can come back to your normal situation very quickly. Let's say you have stores which has which is the warehouse of your finished goods, and let's say suddenly a fire happens, right? So as a result, you better have another backup store, right? So like not putting all the finished good into one warehouse, like distributing among two warehouses. If something happened to one warehouse, still you have some amount of products in another warehouse which you can distribute to the customers and maintain customer. You have retained your customers. So it's very important, very good strategy to reduce your risk. And the final one is internal controls. In the next week session, we will be discussing in very detail internal controls. Sometimes you can, in a business organization, actually this can be applied mainly to internal risk, like can apply to external risk as well, but mostly to internal risk. If something like before something happens, before a risk happens, you are maintaining some piece of activity, just a small activity, to make sure that that particular thing is not happening at the moment. Like as example, before moving there, so I'll quickly explain that the internal controls are having like three types of internal controls. That is detective internal controls, preventive internal controls, and corrective internal controls. We will discuss in very detail these three in the future. But for the moment, this preventive internal control means you are putting a control, right, before something happened, before something negative happened to that particular process. Understand? So the detective means something you are implementing a piece of activity after happening something, right? So example, let's say you are implementing or you are inserting CCTV cameras to some operational areas. So that can be considered as a detective. If something happened, you can find out, okay, what has happened by using the CCTV cameras. Likewise, there are some preventive internal controls as well. Maybe there is a risk of breaking down your machines, and which will negatively impact your smooth business operation. So you can have a preventive control, like every like once a week or every day morning, you are checking all the ingredients, or like whatever the technical aspects of your machines, whether it can run smoothly. Let's say you are a distributing channel, you have a distributing lorry. Okay, so if something happened to the lorry, if it breakdowns, your entire deliveries can be stopped. So therefore, you should be like having some preventive controls, not to break it down, like to make sure the vehicle will be at the current or the good conditions every day. So maintaining regular services and having all the daily checkups. Right? So these are what you meant by the internal controls, not to happen any negative thing. Actually, not to happen, not to happen. Actually, it's to reduce the impact. You may have done the regular services to your motor vehicle, or you may have done all the daily checkup, but still there is a risk of breaking down the motor vehicle. So you can't just eliminate the risk, but you can reduce it up to a certain level to reduce the negative impacts coming from these areas. So dear students, so this is a very important slide. This slide, I think everything is summarized in this slide. All the techniques, there are 4 main techniques. Be very clear about these techniques, because when it comes to the exam focus, I'll show you one past paper question, how these come in. So you need to clearly identify what is risk avoidance, what is risk acceptance, what is risk transfer, and what is risk reduction. Because the question may come with a minor case study saying one incident, okay, there is a business organization, they are facing these difficulties. As a result, they have done these things. What is the risk managing technique? You have to clearly identify from these 4. I will explain with the past paper question, don't worry. But for the moment, be very clear. What is risk avoiding? That means you can't face this risk. It's not worth to face the risk. You are just leaving the business, shutting down your business, and you find out something else profitable. Then the risk acceptance means, again, you can't do anything to the risk, right? But still, that risk is very minimum. It's within your control, within your tolerance level, and happening such incidents also very remote. The likelihoodness is very minimum. So you just live with the risk and you just run your business organization as usual with the risk. Then the third one is risk transfer. That is, you are transferring the risk, the negative impacts coming to your business organization to a different party. The best and the most common example is insurance. And the fourth one is the risk reduction. There, because of a incident, the negative impacts coming to your business organization may be significant. So you have 4 strategies to minimize or reduce that particular risk. What are those 4 sub strategies? That is, diversification means dividing your business operation, right? Without focusing only one business organization, you are focusing your operation in several areas. If something happened to one business organization, but still you are having different other set of business organization like this, or the big groups like John Keel's, Haley's, Hema. That's what these people are doing. Then the second sub strategy is the risk sharing. Sometimes you can't, if the things are really uncertain, right? You can go there with another party to share the risk. If a positive impacts coming, so you can improve and go ahead. And if the negative impacts are coming, still there is another party, 2-3 parties to share the loss and move forward. Third one is the BCP, business contingency plan. If something happened to your operation, you have to make sure that there's another way of doing the same operation. Finally, the internal controls, mainly before coming a risk, how you can address and reduce the risk. Understand? So these 4 main strategies, as well as the sub 4 strategies coming under risk reduction, is very important, and we will see how it comes in the business in the exam context. So before moving to this, our last 2 slides, that is the technological aspect, I'll quickly go through these 2 past paper questions and see how the questions are coming. Just look at the 2019 July. In the latest exam paper, that is 2020 January, they don't have tested the risk management framework. But before that, your 19 July paper, the question number 2 is from the risk management framework. Just read it, will you? The following matters were discussed by the board of directors at a recently held board meeting of Lotus Limited. First point is closing the production line of a business unit due to poor performance. Second point is entering into a joint operation arrangement with another party to operate in a new market. Third point is performing of periodical fixed asset verification. So you are required to state a situation where the risk acceptance is considered as an acceptable method to mitigate risk. And part B, identify the risk mitigating methods used for each of the risks given from 1 to 3 above. Before going to part A, I will quickly discuss part B. Now you need to identify these 3 points: closing the production line, entering into a joint operation agreement, performing a periodical fixed asset verification. So identify the risk mitigating strategy. So what are the strategies? First one, closing the production line. What is that? So there is a risk of, like the question says, closing the production line due to poor performance. But because of this poor performance, what can happen? The company or the entire company can be ended up with a huge loss because the company is not performing well, or that particular production line is not performing well. Maybe let's say you are in the business biscuit manufacturing industry, and you are manufacturing 4 types of biscuits, and one type is not performing well. People don't like to eat that particular type of biscuit. So then no point of incurring a loss, and it will end up with the group level, the company level loss. So therefore you better closing down that production line. So what is the strategy? What is the strategy? The strategy is risk avoidance. The first circle, you are closing down the existing loss-making business unit. Second one, entering into a joint operation arrangement with another party, right? Like I said, as a risk reduction strategy, you can, the second sub classification, risk sharing, entering into a joint arrangement. You are not alone here. You are having another party to enter into this new market. If something happens, there's another one to bear the loss. That is a risk reduction strategy. Under that, the more specific strategy is the risk sharing. Then finally, performing a periodical fixed asset verification. That is a internal control. There is a let's say there is a risk of fraud, there is a fraud risk. Your assets of your companies are like people are more to steal the asset of your company or misuse the asset. The employees of the company using the assets of the company for their personal users. That's a risk, fraud risk, and there will be a negative impact of having a loss to the company. So you are performing a periodical fixed asset verification. So that is the internal control. As a result, like you are randomly selecting few assets and see whether those assets are there in the business organization. So then if some controls are happening like that, the employees are reluctant. They are thinking twice to do a fraud or maybe to use it for their personal work. They are thinking twice, so that you can avoid, you can reduce that risk. So the third one is the internal control coming under risk reduction strategies. Okay, then part A of the question is state a situation where the risk acceptance is considered as a acceptable method. The second circle, I told that you can accept the risk when there are three conditions are there. So the answer should be these three conditions. The impact coming from the risk is low, and the likelihood of the event is very low, and the risk is within your risk tolerance level. So these are the areas tested in your exam during last 10 question papers. When you analyze in the past papers, the next area is something new we have incurred into the syllabus: risk management and information technology. Because as I told you, information technology has become a big part in most of the business organizations, and which is something you can't escape now. So the importance of this information technology factor is there can be risk coming from information technology, as well as you can use information technology for risk management purposes as well. So there are few concepts, few areas you need to be thorough with. I think in your syllabus we are very in a very summarized way we are addressing these areas, but you better have a thorough understanding, like with all the readings, and maybe again with the technology you can just Google and see what are these concepts, how the, because now in the auditing subject, within the auditing subject we are focusing very narrowly on the impact coming to a business organization and how you can mitigate that by using the technology. But if you can have a thorough knowledge or understanding on these areas in very detail by reading and referring to the websites, right? So it's better to have a good understanding, because these concepts are having their own benefits, disadvantages, and those there are some concepts relevant to some business organizations, some are not relevant to particular business organization. So therefore having a thorough knowledge is really important. And most importantly, apart from your exam focus, this is going to be the future. One day when you are working in a business organization, and maybe today we are discussing and addressing these things very slightly, but when you are working as an accountant or a finance manager or auditor one day, and these are the things you need to deal with in the future. Therefore very important, you can't take it very slightly, and you need to continue your readings and education understanding on these technical areas continuously. And these things are very common these days and not very technical. There are no any technical jargons when it comes to IT these days. IT has become a very basic requirement of human beings as well as business organizations. So you have to continuously follow these areas. The first one is basic risk visualization programs. So that means not like in traditional days. Traditional days means when it comes to risk, you are just manually trying to find out what are the impacts coming from different environment and how it's going to impact our business organization, and you are trying to find out solutions. But now there are technological softwares and some computer programs are there. Those are like those represent, those showing you the risk you are facing in a very visualized way. And not only your risk, let's say you are running in a business organization, right? What, let's say a banking industry. So what are the risks coming into you? Maybe inputting some data about you. So you can get, okay, these possible risks are there coming in the future. So you can look at a computer screen and find out, okay, these are the risks I'm going to face in the future by inputting your own data. At the same time, as a bank, what are the general risk factors coming from the industry? These factors also you need to address. At the same time, it will give the information of your competitors as well. Okay, you are facing this type of risk, and this is your competitor's risk, and you are, when compared to a competitor, this is where you are. Likewise, some basic risk visualization program software is now available, and most of the business organizations are using. It's not the traditional way of monitoring business risk and addressing them. Then the second factor is social media has become a very, very important factor today, because we have seen, right? Now, those days, the customer is not that much of aware. Even though they consider the customer as the king, most of the time, the real profits or the real king was the businessman. The customer is not aware about the product, the market, and the customer awareness was very minimal. But with the changes and with the popularity with the social media, now the customers have become very popular. Customer awareness has come to a level that was never before, right? Sometimes business organization can't do even a single thing against the customer, because everything's now in the social media, and the entire world can know what's happening. And I think I'm not going to tell any examples. You may can remember there are a few business organizations, when they have done something wrong to the customers, people were recording those stuff and publishing in the social media. There's a very negative image to the business organization. These things will continuously happen over the last couple of years. I'm not going to tell the names of such companies, but you can just remember. So these things are happening at the moment. So because of this concept, social media, now business organizations are facing a really risk, that is the reputational risk. At the same time, they can address that risk by using the social media as well. So that's the importance, and find out. So you can read more on these areas. What are the industries you can use social media? Actually, almost all the industries today are running through social media, and even big banks, some big conglomerates like John Keel Sale is having their own Facebook pages, and some customer queries are now handled through Facebook. When people are having a problem with the company, they are logging a complaint to the Facebook page, and the company is addressing. There's a separate relationship manager attached to most of these business organizations to address the social media queries and the complaints and all. It has become such important point these days. And also the following points are also the concepts coming in this technological environment, which you can find out as a risk mitigating mode. Data integration and analytics has become very popular in most of the business organizations. If you take some big companies now, there are, like previously, the chief information officer, CIO, the IT department, it is some traditional department. Now most of the business organizations, now there is a chief analytical officer, chief digital officer. Now these positions have been emerged over the last couple of years, because the data analytics, data integration, how to use these things to generate new businesses, at the same time to mitigate, to like, at the same time you are generating the businesses, then the complaints and all the inquiries also coming in digital way. So you need to address all these things. You need to focus on these areas. Then data mining is the process of discovering patterns in large data sets. It's not just raw data, right? Sometimes you can use some data sets and data patterns, how those things have been moved over the last couple of years, and you can apply those numbers and the facts to identify if there's any risk coming, or if something's coming, how we can address those stuff. Then the open data is another important thing. That is simply the information appearing in information or data appearing in the open websites. If you just Google something, there are so much of information coming. That's what you meant by the open data. The data or information which doesn't have intellectual property right. So you know that there are some data or information, right? If you take a book which contains so much of information, but you can't easily or you can't freely open the book without paying for it. That's an intellectual property. But at the same time, there are so much of other books or information in the web, open web. You just type the name of the book, it will appear, you can read it freely. Those type of things are open data which you can use in your business organizations for the betterment. So then cyber security has become another important thing. When you are more focused on to the technology, the risk also coming from the technology is really high. So you need to make sure that the security is really important, because maybe your confidential data is exposed to, can be exposed to different party or the unwanted parties, right? Some hackers can access your information when everything is in computers, and there's a risk attached. You need to be bit of a have a focus on those areas. Now finally, the artificial intelligence, a concept which is coming like over the last 10 years we are talking about artificial intelligence, but this has not come to 100% implemental level as even today, but very in future these things will be very successful, and very frequently you can see now in some business organizations they are using robots, right? Robots means not the physical robot you may have seen in your movies and all. So there are some small processes, right? In most of the banks in Sri Lanka now they are using robots to do their uh, operations, like some repetitive work. When data is coming, enter it and just save down in a location, some simple process like that. Maybe a program software, it can be written which can be considered as a robotic process automation, RPA, which is a very famous concept these days in most of the business organization, in order to reduce the cost and in order to increase the accuracy as well as to efficiency. The companies are moving toward these things. So the technique behind this robot is what we call the artificial intelligence. Without the human brain, you are letting the computer to think and react. So that's simply what it means. um, Over the last couple of years, it was under discussions and some were applying, there are failures, again applying, but very near future, it will be a successful story in 100% in most of the business organization. And we have to be very careful when we are looking at the risk of a business organization. Then finally, benefits and disadvantage of this IT side. We have actually, this is what we need to manage as the risk by using a IT system, IT environment in our business operation. First one, of course, competitor analysis. Traditionally, it was your company. What's the risk appearing to you? Now, it's not only you, because you are on the social media as well as your competitor is also social media. The same risk facing by you is facing your competitor as well. Now, it's visible to both the parties. Very transparent. Your competitor analysis is very easy. And the asset protection, you can use these things to protect your assets, like you know that some digital codes, barcoding, GPS systems, right? So these things can be used as a asset protection. Whether you are the company motor vehicle is used for the personal use of your for the driver of the company, you can use a GPS tracker, whether the motor vehicle is in the office or the office premises or somewhere else, right? So that's how you can use the technology to protect your assets. Then the reputation management, as I told you, social media plays a vital role here. So you can use the same social media platform to make sure your reputation is safe. Then the supply chain risk. Actually, supply chain risk is, now let's say you are in a manufacturing business organization, you are running a flow, operational flow. If one step of a flow is broken, the entire process can be damaged, right? Let's say a hotel chain, hotel industry, the suppliers may be providing foods, then the hotel kitchen staff will be prepare the meal and then it will be served to the customer. So that's the process. If something happened to one of these supplier, maybe that end result of losing the customer can happen with the broken process. So therefore, it's really important by using technology, you can use this. And also, as I told, the intellectual property protection is also you need to focus and follow with the technological aspects. And the negative side of this is the framework can be very complex, right, and difficult to understand when it comes to technology. For some areas, some business organizations still great, because the computer literacy of our country is still at a very minimum level. So these are areas we need to focus and grow more. So therefore, companies which can't understand these complex structures and how we can really use it for the betterment of the business organization. Then difficulty in implementing due to various reasons, such as high cost. Of course, the cost is high. At the same time, the benefits are also high, but you need to incur some huge significant one-time cost for all this infrastructure and all. Then the potential threat to data. Obviously, you are now open. You are open to the environment and open to the world. At the same time, there is a threat of losing your information and your secrets. All these things can be. Then the performance is also still, we are not 100% fully digital country, right? So infrastructure is not that good in terms of doing the business organization. It has not become basic requirement still in a country like Sri Lanka. So there can be performance issues. And at the same time, depending, this is a very big concern these days, depending on external entities, right? Let's say if you are running a hotel, you need to have some risk visualization tool. Sometimes we to developing the tool inside the business organization is very difficult. So you need to purchase this from outside entities with a huge cost. And once you purchase the product, also they are not giving you the full access, right? In case you need to do some changes to the model, you need to go back to them, asking their help. Like you need to keep a maintenance agreement with them. Even though you purchase the software, you are continuing a maintenance agreement. Every year you need to pay them, because if something happens, you need to call them, because you are not having the, maybe not the knowledge, but you are not having the authority to change to the systems and all. Encrypted data can be there. As a result, you need to depend on some external entities. So this is what actually coming under this chapter, risk management framework. Previously, it was only the internal and external risk factors, as well as the risk management process with the techniques. But in your new syllabus, very important, the technological part has come into play. As I told you, don't take this area only with the exam focus, because this is going to be the future. And one day you may acting as a finance manager or an auditor or accountant. This is what you need to deal with in the future. So therefore, don't limit your knowledge on this IT side on the risk management factors to the syllabus, right? So read, just Google and see. There are so much of information, and this information are getting updated day by day. So you have to be in touch, and if you are in the touch, so you can write a good answer as well in your exam papers. So focus more on these areas and be prepared for the exam. So that's it for the chapter number 2, risk management framework. And if you have any question, I think a few questions are there. Let me answer to those questions as well. Diversification means we can say like different portfolio. Exactly, that's what. So this diversification strategy is coming in, especially when you are investing in share market and when you are learning financial management. You will learn this diversification strategy in a very detail, with the numbers, with the proof of numbers. Like when you are investing in the share market, the simple logic can be applied. So if you are purchasing a share of one single company, right? So there is a risk of not having a desired return, right? So then why only investing in that company? Divide your money and invest in 2 different companies. And if you can diversify it further into 2 different industries, right? Quick example, I'll quickly say, like, let's say you are planning to purchase some share of a business organization in the share market. Let's say you purchase share from a bank A, right? And you diversify. Okay, you purchase shares of bank B as well. If something happened to the bank A, but still the bank B is there. You have invested some money, you can get some return, but you can further diversify it not only to banks. You are investing in a bank, and again you are investing in a hotel industry, because if something happened to bank A, obviously bank B also will get affected because they are operating in the same industry, right? So probably your diversification is not a successful diversification strategy. So therefore diversify it more in like more unrelated areas, bank and a hotel, or bank and a transport industry, or some manufacturing, some product like soap, leather products. Likewise, that's how the diversification strategy should be. And when you are learning financial management in future, so you will learn those things in very detail with numbers. But as a risk management practice, for the moment, in summarized way, keep in your head what do you mean by diversification. Okay, there's another question as asked above: an insurance company is a diversification or transfer? Insurance company is a transfer. So you are transferring your risk to another party, that is the insurance company. That's not diversifying. Diversifying means your main business operation divided into two parts, and you are focusing two different areas. If something happened to one area, but you are still left with another area, that's what you meant by diversification. But transfer means you are running a one single business process, right? If something happened to that process, or maybe let's say you are having a one big machine and manufacturing something, right? If something happened to the machine, right, you can diversify it by having another machine. That's a different strategy. But without having another machine, the same machine you can insure. If something happened to that particular machine, you can transfer the loss to the insurance company. That's what you mean by. That's a good question. Likewise, you need to clearly identify the differences of each techniques, which is very important, as in your examination, the question is coming with a mini case study, as I told, a minor case study with some practical application. So you have to be very clear on these risk mitigating strategies. So if you have any other questions, so I can quickly answer. If there are no any, okay, there are another set of questions. What are the two types of frauds? This will be, we will learn in very detail in future. First one is the misappropriation of asset. Second one is fraudulent financial reporting. So that means sometimes you can do a fraud and prepare financial statement incorrectly. You're preparing a financial statement incorrectly. Your revenue is only 1 billion, but in order to show a better picture, you are showing it as 1.5 billion in your revenue figure. That's fraudulent financial reporting. And the second fraud is the misappropriation of asset. That is the motor vehicle for the business purposes, you are using it for your personal purposes, or you are some stealing cash from the business organization. Those are the two types. If a group company has an insurance company as a part of them, is it a risk transferring or risk diversification? It's the both. And most of the business organizations are doing that. If you take the John Keel's holding, they are having their insurance arm, Union Assurance, right? Likewise, there's another group, Mr. Harry Jayawardene, and he's having his own insurance. Likewise, most of these conglomerate, they are having their insurance companies as well. So that's the diversification strategy, as well as that's a risk transferring strategy. Can we get the slide? Of course, a slide will be sent by AAT. These notes be enough for the exam, or do we need to have more knowledge on these lessons? Actually, the slide is a very summarized form. You can refer it, and your AAT textbook, I think that's 100% sufficient for your exam. But when it comes to these IT areas, you better read and obtain some external knowledge as well, because things are expired day by day. Maybe the definition we have given to the cyber security today can be totally different when it comes to your exam date. So you better be updated when it comes to IT side, and most of the general principles and core areas, the slides and the books will be sufficient. Yes, I think that's it. Are there any questions? Why can't we have national policies? Okay, I think that this is not the most suitable time to answer that question. That's something we are having with this traditional way of having all these things and political ways. As a result, we are unable to have a national policy. when the government change, they are having with their own policy. Now, if you take a country like USA, Britain, UK, so they are having national policy. The government will change, that the policy will be there forever, not forever, maybe for a long time. Whatever the government coming, they are executing the prevailing policy. So fortunately or unfortunately, that's how in Sri Lanka. Okay, I think that's it. Most of the questions I answered, and I hope you had a good understanding and knowledge of the areas. With that, we'll wind up and we'll meet next week. And very important, next week, now these two sessions, what we discussed last week and today, is purely the background of business organization and their natures, objectives, factors affecting. Next week, we are purely starting the technical side of auditing with the internal controls and internal controls and the business processes. With that technical areas, we'll be starting our third session. And from that point onward, we'll be continuously doing auditing aspects, some technical areas you may heard for the first time in your life. So be ready. We'll meet next Sunday on the same time. So thank you very much.
Thank you very much, Taranga. Today we learned what is risk and how to mitigate those risks and what are the procedures that we can follow to eradicate those risks. So students, that AAT Sri Lanka is planning number of webinar series for all stages. That means level 1, level 2 and level 3 and all mediums. So you can join with us, and we are planning to have these sessions at 10 a.m. Stay with us. Thank you.